You know that feeling, right? The first few minutes after the market opens, it's just pure chaos. You've got this flood of volume, prices are whipping all over the place, and it feels totally random. But what if I told you there's a way to find a clear signal inside all that noise? That really is the million-dollar question. How do you take this moment of peak insanity and actually turn it into a structured, tradable opportunity? Well, a lot of traders turn to a classic, time-tested framework to do exactly that. So yeah, let's get into it. It's called the Opening Range Breakout, or ORB for short. And the core idea is actually pretty simple, but it's powerful. You let the market show its hand in those first few minutes. You define a range based on that initial fight, and then you trade the breakout. This isn't some new fad either. This concept's been around since the 1960s because it's built on a fundamental truth about how the market behaves right at the open. So what is that big truth? Why does this initial period carry so much weight? Well, it all boils down to the statistical nature of the opening price itself. Check out this quote from Adam Grimes. It's fascinating. After crunching the numbers on thousands of charts, he found this really clear pattern. The day's opening price tends to be super close to what will become the final high or the final low for the entire day. And it makes sense, right? The open is when all the big institutional orders finally hit, and all that overnight news gets priced in. That first big move, it really does set the tone. Think of it like the market's opening argument. All those pent-up orders, all the reactions to what happened overnight, it all gets unleashed in a single moment. This first battle between the buyers and the sellers is fierce, and whoever wins often dictates the direction for the rest of the day. In the ORB strategy, it's designed to help us capitalize on the exact moment a clear winner emerges from that fight. Okay, so we get the why behind it. Now let's get practical and see how we can build an actual blueprint for a trade. First things first, we gotta define this range. And this chart shows it perfectly. So you pick a time period. Let's say the first 30 minutes of trading. You watch the price action, these little candles here. You find the absolute highest point the price hit in that window, and you draw a line. Then you find the absolute lowest point it hit, and you draw another line there. And that's it. These two lines are your opening range. Everything in between, we call that the chop zone. It's an area of indecision, and you want to stay out of it. Now, the exact time frame you use isn't set in stone. A scalper, a trader who's trying to grab tiny, quick profits, might just use the first 5 minutes to get a super fast signal. But someone else might prefer to use the first 30 or even 60 minutes to get a more established, reliable read on the market sentiment. The key is just to pick a time frame that fits your style and stick with it. Be consistent. Okay, blueprint's ready. Let's walk through the actual execution. How do we go from drawing lines on a chart to actually placing a trade? It's really just a simple 4-step process. 1, you pick your time frame. 2, you mark your high and your low. 3, and this is crucial, you patiently wait for a full candle to close outside of that range. A close is confirmation. And 4, the most important step of all, you have your entire trade plan, your entry, your stop loss, your target, all figured out before you even think about clicking a button. Now, when it comes to getting in, there are kind of 2 main ways to do it. The first is to jump in right as that breakout candle closes. It's aggressive, and it can get you into some really powerful fast moves, but it's also riskier and more vulnerable to false breakouts. The second approach, which is often a bit safer, is to wait for the breakout and then watch for the price to pull back and retest that level it just broke. If that old ceiling now becomes a new floor of support, that's a much higher probability signal to get in. And here's the thing. This strategy can't be used in a vacuum. You need context to stack the odds in your favor. I mean, is the stock already in a strong uptrend? Then you should probably only be looking for buys. Was there a big earnings report or some other news? A catalyst gives the move a real reason to happen. And finally, look at your volume. A real committed breakout should happen on a big spike in volume. That's confirmation. All right, now for what is probably the most important part of this whole thing, the reality check. Because not every breakout is a clean winner. In fact, a lot of them fail. And that's where traders get absolutely wrecked. On the left, that's the dream, right? Price closes outside the range and just takes off. Beautiful. But on the right, that's the trader's nightmare. It's the fake out. The price pokes its head just above the line, just enough to trick all the eager breakout traders into jumping in, and then it reverses, hard, stopping every single one of them out. Understanding this risk is absolutely key. So get this, there was this fascinating case study from a trader who decided to backtest one of those popular ORB strategies you see all over Instagram. You know, the ones that promise these insane 4-to-1 profits. But once he actually built a proper test and fixed the bugs in the code, he found the hard truth. The strategy, as advertised, was a consistent loser. But here's the aha moment. He didn't just give up. He started playing with the rules. Instead of trying to hit these massive home runs, he flipped the logic. He aimed for smaller, higher probability wins, but gave the trade a much wider stop loss. This totally boosted his win rate, and all of a sudden, the backtest became incredibly profitable. The lesson? You have to test and validate every single rule for yourself. And that brings us to the real heart of the matter. The strategy itself is just a tool. It's a simple framework. The real job of a trader isn't finding the perfect system. It's mastering your own process, your risk, and your discipline. These 3 things right here are completely non-negotiable. For any trade, you have to know where your exit is if you're wrong. That's your stop loss. You have to size your positions so that if you do get stopped out, the loss is just a small, manageable hit. And you have to make sure the potential upside is actually worth the risk you're about to take. Honestly, learning the technical stuff is the easy part. It's the mental game that separates the pros from everyone else. It takes so much patience to just sit and wait for the right setup and not gamble inside that choppy range. It takes incredible discipline to control that fear of missing out, that FOMO, and not chase a move that's already gone without you. This quote just says it all, doesn't it? For most of us, on most days, the single most profitable thing we can do is nothing. Just waiting for that one single high-quality setup is infinitely better than taking a dozen mediocre trades. So let's bring it all home. The opening range breakout strategy is not some magic bullet. It's not a license to print money. It is a framework, a way to bring structure to the most chaotic part of the day. The profit doesn't come from the strategy. It comes from your process, your testing, and the discipline to execute your plan perfectly, day in and day out. But enough for me. What about you? Is this a strategy you use? What time frames work best for you? And more importantly, what are your best tips for avoiding those nasty fake outs? Let's get a good conversation going down in the comments. Thanks for watching.